Scooby Algo Trade, welcome back to Scooby Doo. Oh, hold on, I have to answer something here. Something allow this bash command, whatever. Okay, so I'm just going to do a bit of start off with a bit of fun here, which is the jargon. All right. So, and then I'll get into some interesting days I've had with see, half the time, although this all seems very organized, which is like, but it's AI kind of has it all organized for me. And sometimes I'm just doing what it tells me to do in a way. I have a fair idea what I'm doing, but anyway, we'll get into that. We've had some, I always seem to be fixing bugs all the time. So that's the thing. We did a hell of a lot. I did a hell of a lot of research on the QLib thing and the RDH and stuff. And basically what happened with that, before I get into this jargon comedy bit, is that I'm kind of drawing a line underneath it for the moment. The Sharpe ratio deflation basically proved it to be wrong, because what the agent was doing was, say, flipping a coin 116 times, and say one of those 116 times it landed on heads 100 times out of 100, and it took that as the best one and said, look, this is great because just by chance it landed this way. Now, this is the way AI explained it to me. And I was kind of like, well, I thought the whole point of this was like we had it secure, and this thing wasn't meant to happen with this, because, you know, it's offering up factors and it's offering up, you know, and I thought the idea was to figure out which one is the best one. And obviously that's not really the way it works. Apparently this deflated Sharpe ratio thing is really the thing the measuring stick to measure it by. And as soon as we did that, the whole thing fell apart, which was weeks, maybe even months. Well, even you could say years, because I've been doing it for years on the QLib stuff and the RDH and stuff, which I was most interested in. So I'm so disappointed on that. And it really did seem that I had a signal, and not a very good one, but a signal nonetheless, which I was kind of hoping to actually, you know, at least paper trade, but I didn't even get that far. So it's back to the drawing board with that one, I suppose. I don't know what this is for, daily capture. Half the time I don't even know what it's asking me, but hold on, I'm going to sneeze. Okay, so we're just going to have a bit of fun here for a minute. The quant jargon translator. So there's 4 things in options, because we've been doing options a bit lately. This keeps asking me. Folio backfill, I don't know. Hopefully I'm okay allowing it to do that. Anyway, so we've been doing options a bit lately, and covered calls and stuff, and try and cash secured puts and things. So the Greeks, right, one of them is fake. So the cold open, so right, delta, gamma, theta, and vega. They're very impressive, they're very ancient, they're very scholarly. One of them is not a Greek letter, they just made it up. So I'll let you sit with that. The premise, here's my theory. Finance has a problem. What it actually does is fairly simple. And if people understood it, they'd want a discount. So it built a wall. And the bricks in that wall are words. I'm dyscalculic, and numbers genuinely swim on me. If I can get over this wall, the wall is not as high as they're telling you. 4 bricks today. Delta. What they say, the first derivative of the option price with respect to the underlying. What it means is if the stock moves a quid, how much does my option move? So delta 0.3 means stock goes up £1, my option goes up 30 pence. That's it. That's the whole thing. And here's the bit they bury. Delta is also roughly the chance your option ends up mattering. So delta at 0.3 is equivalent to about a 30% chance. So when I sell a put at 0.3 delta, I'm saying there's roughly a 1 in 3 chance I end up buying this stock. One number, two jobs. That's not maths. That's a weather forecast. Next is theta. And what they say is the rate of change of option value with respect to the passage of time. What it means, an option is an ice cube. You buy one, you're holding an ice cube and hoping something happens before it melts. I sell them. I am not holding the ice cube. I'm the fella selling the ice cubes. That's if I sell them. And I'm selling them in a warm room, taking the money up front. Theta is how fast it melts, and it melts faster near the end, which is why I'm not sitting there watching it drip for 45 days when most of the melting happens at the finish. And gamma is the next one, and what they say is the second derivative of the option price with respect to the underlying. And what it means, delta doesn't stay still. Gamma is how fast delta changes. Think of driving. Delta is your speed. Gamma is your foot pressing the accelerator. You can be doing 30 and be perfectly grand. But if your foot's flat to the floor, 30 is not where you'll be in 10 seconds. That's the one that gets people. They look at their delta, decide they're fine, and don't notice the accelerator's buried. Gamma is why it was only 0.2 delta is the last thing people say before it stops being a 0.2 delta. And vega is the imposter. And what they say is its sensitivity to implied volatility. What it means, how much your option price moves when everyone gets nervous. Fear has a price. Vega is the receipt. And now the good bit. There is no Greek letter vega. Never was. Alpha, beta, gamma, delta, theta. They're all real, all ancient, all Greek. Vega is a star in the constellation Lyra. Some trader in the 70s needed a word beginning with V. Looked out the window and went, that'll do. So the next time somebody in a quarter zip tells you the Greeks are too complex for you, one of the four is a star they saw out a window and couldn't be bothered checking. And the point, delta, it's how much it moves. Theta is how fast the ice melts, so just to recap. And gamma is how hard your foot's down. And vega is what fear costs today. 4 ideas, 4 words. Any of you could have explained those to me down the pub in 10 minutes. The wall isn't tall, it's just painted to look tall. So in the next section here, we're going to do the Sharpe ratio and why a number that sounds like a knife is actually a question about how well you sleep. So series list for later for the next bit is the Sharpe IV versus HV and IC information coefficient, the wheel, alpha and beta, deflated Sharpe, and that's the one that's got the proper story in it, which I'm going to tell you later, and a number invented because people kept lying with the first one. Want me to file this to drive, blah, blah, blah. That's, yeah. Okay, here's the next one. I said go ahead and just give us the next one anyway, and here it is. So the Sharpe ratio. This is more like a podcast, really, isn't it? You don't really need the screen. So just listen along and crunch away on whatever you're crunching on, or drink away. I'll have a drink with you here, 7-Up free. Okay, so the Quant Jargon Translator, episode 2, or the next section, whatever you want to call it. So the Sharpe ratio, and the number invented because everyone was lying. Last time, we did the Greeks and found out one of them was a star somebody saw out a window. Today, the Sharpe ratio. It's not Sharpe, it's a fella called Bill. The premise, somebody tells you they made 40% last year. Great, well done. Wrong question. The question isn't how much did you make, it's how much did you have to suffer to make it. Because I can make you 40%, I can also lose you 60% doing exactly the same thing. And whether you got the good version or the bad version, it's mostly down to what month you rang me. That's the whole idea. And that's Sharpe. What it actually is, what they say, excess return over the risk-free rate dividend by the standard deviation of returns. Yes. What it actually means is return per unit of wobble. So 3 bits. 1, what you made. 2, take off the boring money. You can get 3 and a bit % right now sticking cash in government IOUs and going to bed. That doesn't count. Nobody gets a medal for beating a mattress. 3, divide the wobble. How much did it lurch about on the way? So, steady grind up, small wobble, big number, good. Up 40, down 30, up 50, down 35, same destination, terrible number, and you've aged 11 years. What the numbers mean, roughly, and everyone argues about this. Under 1, you're not being paid for the stress. 1 to 2, genuinely decent. Most real strategies live here. 2 to 3, very good and very rare. And above 3, you're either one of the best in the world or something's wrong. Above 5, somebody's either cheating or fooling themselves. Usually the second one, which is worse because at least the cheat knows. And now, the villain. Here's how you fake it. And I want to be clear, almost nobody doing this thinks they're cheating. That's what makes it dangerous. You have an idea. You test it on old data. Rubbish. So you tweak it. Still rubbish. Tweak it again. Try a different month. Try leaving out 2008. Try 3 days instead of 5. 200 goes later. Brilliant. Sharp of 3. You've not found a strategy. You found the one combination out of 200 that happened to fit the past. Try 200 keys in a lock and one will turn. That doesn't make you a locksmith. That's called overfitting, and it is the single most common way people lose money slowly while feeling clever. The fix, the deflated sharp. Some people got sick of this and built a number that asks one extra question. How many goes did you have? That's it. That's the innovation. How many times did you try before you got the good one? 200 attempts, sharp of 3, deflated sharp drags it down toward nothing because with 200 goes, you'd expect to stumble on a 3 by pure luck. 1 attempt, first go, sharp of 1.5, wrote it down beforehand. What were you testing? That survives. That's worth more than the 3. And here's my rule, and it's the reason I bother with any of this. Every dead idea counts as an attempt. All the ones I binned, the ones that embarrassed me, if I don't count the failures, the number's a lie. And the only person it's lying to is me. The point, sharp ass. Were you paid enough for the pain? Deflated sharp ass. And how many goes did you have before you got the answer? The second question is the honest one. It's also the one nobody asks in a YouTube thumbnail. Anyone can show you a good number. Ask them how many goes they had. Next time, implied volatility versus historical volatility. The market's guess about the future against what actually happened. Or as I think of it, the weather forecast versus looking out the window. So 2 episodes ready. Say the word and I'll put the, yeah. So we're going to do them now. We might. Hold on. All right, so we'll just continue on with the quant jargon translator. So IV versus HV, the forecast versus the window. 2 numbers, both called volatility, both measuring wobble. One of them is the market guessing about the future. The other is what actually happened. Everything I do for a living lives in the gap between those two. HV, historical volatility. You take the last 30 days, you look at how much the share price actually jumped about, you get a number. That's it. That's a fact. It happened and nobody's guessing. HV30 means how much did this wobble over the last 30 days. Same as sticking your head out the door and going, yeah, it's been lashing all week. No opinion on it. It's a measurement of the past. Implied volatility, IV. Now, nobody publishes this. There's no bloke typing it in. It's reverse engineered from the price. People are buying and selling options right now. Those options have prices, and you can work backwards from the price and ask, what would the world have to look like for that to be a sensible price? The answer that comes back is IV. So it's not a forecast anybody made. It's the forecast baked into what people are willing to pay. which is a much more honest forecast because they've got money on it. Talk is cheap. IV is what people are actually paying. The gap, where the money is. Now, two numbers. One says what happened, one says what's expected. Divide one by the other and you've got my entire job. IV higher than HV means the market expects more drama than there's been. Options are dear, fears being paid for. That's when I sell. I'm selling insurance to nervous people. The drama doesn't show up, I keep the money. IV lower than HV, that means the market expects a quiet life after a rough patch. And options are cheap. That's when I sit on my hands. I'd be selling insurance too cheap, taking on the risk and not being paid for it. My actual rule, I need IV to be at least 1.2 times HV before I'll do anything. In English, the forecast has to be at least 20% more dramatic than the last month actually was. Below that, I don't trade. Doesn't matter how much I want to. Doesn't matter if it's been a quiet week and I've made nothing. Last Friday, 4 names failed that test on the same day. 4. All told me the same thing. The market isn't paying for fear right now. And the answer was, grand, I don't trade today. That is the single hardest thing in this game, and it's not complicated, it's just uncomfortable. Not trading is a position. It's just one that feels like doing nothing, and nobody puts did nothing today in a thumbnail. The thing people get wrong, high IV doesn't mean good. It means the market's frightened. Sometimes it's frightened because there's genuinely something coming. Earnings, a court case, a drug trial. Then the option's dear because it should be dear. And you're not being clever. You're just standing in front of a bus and getting paid a $5. That's why I check the calendar before every single trade. Is there a reason for the fear? If there's a reason, it's not a bargain. It's a warning. If there's no reason, that's the trade. And the point is, HV is what happened. It's a fact. IV is what's expected. It's a price. And the gap is whether it's worth turning up. And the discipline is this. The gap decides, not me. I don't get a vote. I just get to look. Next time, the wheel, which sounds like a strategy and is actually just 2 trades wearing a trench coat. Now, the 2 stories. Let me find them rather than reconstruct from memory. So, both found on the whole project because it's when everything broke. Okay. Oh, here's the stories, right? Here's the stories. So that's the end of the jargon. And then these are the stories, right? The 2 bad days in a row, right? So there was 2 days. And this is all had to do with the QLib thing. And I'll just finish up here. And this is where the research kind of ended. So that's why I ended up getting into the options and stuff. But I do hope to get back into the research. And I'll let you know when whatever I'll be doing with that. I'm not sure. I do hope to use QLib and RD Agent again because I like them. And it took me ages to find them and get them to work, everything else. But they may not be as good as all that. But maybe we'll use them, maybe we won't. But anyway, here's the 2 bad days that I had that, So they came together. So 2 days, they were at the end of July. And they cost me a year's work and were the best thing that ever happened to the project because, otherwise it probably could have lost a lot of money if I believed them. So Friday, the plumbing leaked, and Sunday we found a spanner in the engine. Day 1 was Friday, 31st of July, the plumbing. 11 things broke in one afternoon. 11. Felt like the world ending. It wasn't. It was one mistake made 11 separate times. The mistake, every bit of the system was quietly assuming the stuff feeding into it was fresh. None of it ever checked. Prices go into a store feeds a calculation feeds a signal feeds a log feeds a chart. 5 links, and not one of them ever asked, here, when were you last updated? So the store froze, and the calculation didn't notice, and the signal didn't notice, and the chart drew me a lovely picture of 7 companies I never owned. Nothing errored, nothing went red, no crash, no warning, nothing. That's the whole horror of it. It worked perfectly, and it was wrong. The one that still makes me laugh. There was a little function whose job was, given today, find me next Monday. It went backwards. It found me the Monday that had already happened, which meant the system was buying shares 4 days before it decided to buy them. It wasn't a bug you could fix. It could never have had worked. Not for any date you fed it, not even a Monday. Somebody wrote it, and on the day it was born, it was already wrong. And it sat there for 5 days, making me look like a genius. And the code was 1 week old. That's the bit. This isn't rot. This is what building fast looks like immediately. The lesson, and it's a big one. If something matters, work it out twice by 2 routes that share nothing. Because here's what people get wrong. Testing your own code tells you it's sturdy. It cannot tell you it's right. That little function ran every week, never crashed once, clean output every time. Nothing inside it could have ever told you it was talking nonsense. It took an outsider. We ran the same trades through a completely different platform, TradingView, in this case, that knew nothing about what we'd assumed, and it disagreed immediately. Not because it was better, because it's ignorant of our assumptions, and that's the whole value. So day 2, Sunday the 2nd of August, the engine. 2 days later, plumbing all fixed, feeling grand. And then we look at the thing all of it was built to produce. One number, T equals 2.09. In this game, that's a pass mark. That's you've found something. It's a signal. That number was the reason the whole project existed. We tested it every way you can test a thing. No cheating with future information, no mixing up training and testing. Audited end to end 2 days before, came back spotless. We'd asked, was this tested properly? Yes, comprehensively. We never once asked the other question. How many goes did you have? We'd let a machine hunt for this thing. It hunted for weeks. It tried 116 different ideas. We kept the one that won. Flip 1 coin 10 times, get 8 heads. Interesting. Flip 100 coins and keep the best one. You've found nothing. One of them always would have, done it that way. So run the number through that test, the deflated one from last episode, and the T 2.09 becomes roughly 0. And then the bit that properly hurt. We worked out how many goes you'd have to have before the results stopped meaning anything. 3. 3 tries. We had 116. There is no honest way to count it that leaves the thing standing. The part I can't unsee, the code that produced it. Its own notes warned about this, written in there by the machine, which is just what I call Claude code, weeks earlier. Careful, this might be selection bias. Nobody did the sum for weeks, until I asked a completely unrelated question on a Sunday that went, hang on. So credit where it's due. While counting the 116 and Claude code found something that inflated its own count, 5 sessions that had returned identical results from a cache, so they weren't real separate attempts at all. It reported that unprompted against itself, because a fake high number is just as dishonest as a fake low one, and honesty isn't a direction you point in when it suits. What 2 bad days bought me. On Friday, things can't be perfectly sturdy and completely wrong. Check from the outside. On the Sunday, 2 separate questions, and passing one tells you nothing about the other. Was this tested right, and how many goes did you have? I lost the signal. I kept the pipeline, the data, and both questions. I'd take that trade again. And I'll tell you the honest bit. I'm not the clever one in this story. I just kept asking, how do you know that? Until something fell over. You can do that too. It's free. It works. So 4 episodes recorded. Yeah, so we recorded all that. Next we can do the wheel and alpha and beta and IC. And he's telling me about context there or whatever. So for there, I think we'll leave that. I think that's like a full episode. I know there was no fancy graphs or anything this time, but that's genuinely where we are. The research has sort of stopped. I'm just back to doing, boring sort of trading things. And but I do like the research. I hope to get back to it. That's just the way it's gone for the moment. And yeah, see you next time here on Scooby Algo Trades. Scooby-Doo.